The United States crypto regulatory landscape is best described as a work in progress, characterized by interagency jurisdictional conflict, enforcement-led policy development, and significant legislative ambiguity. Two primary federal regulators claim authority over different aspects of crypto markets: the Securities and Exchange Commission and the Commodity Futures Trading Commission. Their jurisdictional boundary is determined by a legal question that courts have not uniformly resolved: whether specific crypto tokens are securities, regulated by the SEC, or commodities, regulated by the CFTC. Bitcoin is widely accepted as a commodity. Ethereum is increasingly treated as a commodity following the SEC's approval of spot Ethereum ETFs. The classification of thousands of other tokens remains contested. For institutional investors, this regulatory ambiguity creates three distinct challenges: compliance uncertainty when deploying capital into specific assets, custody and brokerage limitations from unclear qualified custodian definitions, and strategic risk from the possibility that regulatory reclassification could affect existing positions. Understanding the current landscape, and where it is heading, is essential for any institutional crypto framework. The SEC-CFTC jurisdictional conflict is the central structural challenge of U.S. crypto regulation. The SEC, under Chair Gary Gensler's tenure through early 2025, pursued an aggressive enforcement-led approach built on the argument that most crypto tokens are investment contracts, securities subject to SEC registration requirements under the Securities Exchange Act. The Howey test, developed from a 1946 Supreme Court case involving orange groves in Florida, is the SEC's primary analytical framework. An asset is a security if it involves an investment of money in a common enterprise with an expectation of profit from the efforts of others. The SEC applied this framework to over 100 enforcement actions against crypto exchanges, token issuers, and intermediaries. The CFTC, by contrast, has publicly stated that Bitcoin and Ethereum are commodities, a classification that subjects them to lighter-touch regulation focused primarily on derivatives markets and anti-manipulation. The crypto industry has generally preferred CFTC oversight, and several congressional proposals have sought to expand CFTC jurisdiction as a deliberate alternative to SEC oversight. The practical effect of the ambiguity is that large institutional investors have been reluctant to build significant infrastructure around assets whose regulatory classification, and therefore the legal obligations of their custodians, brokers, and advisors, remains uncertain. The regulatory timeline from 2024 to 2025 represents the most consequential period of U.S. crypto regulatory development to date. The January 2024 spot Bitcoin ETF approval, after years of SEC denials, was not simply a product approval. It was a de facto regulatory determination that Bitcoin is a commodity, that its markets are not susceptible to manipulation at a level requiring securities registration, and that institutional exposure through an exchange-traded wrapper is appropriate. The May 2024 spot Ethereum ETF approval extended this logic to ETH, providing meaningful, though not formally binding, clarity on Ethereum's regulatory status. The same month, the Financial Innovation and Technology for the 21st Century Act, FIT21, passed the House of Representatives with 279 votes, including significant Democratic support. FIT21 would create a comprehensive framework for crypto market structure, establishing clear criteria for when a digital asset is a commodity versus a security and dividing regulatory jurisdiction accordingly. Senate passage and presidential signature remain the outstanding legislative hurdles as of early 2025. The 2025 administration change brought significantly different regulatory posture to both the SEC and CFTC. Multiple enforcement actions initiated under Gensler's SEC were withdrawn or paused. New leadership at both agencies signaled intent to develop clear regulatory frameworks through rulemaking rather than enforcement. The full U.S. crypto regulatory map extends beyond the SEC-CFTC binary to encompass 5 distinct regulatory bodies with overlapping mandates. The SEC asserts jurisdiction over digital assets it classifies as securities, including many altcoins and token offerings. The CFTC regulates commodities markets including Bitcoin and Ethereum spot and derivatives markets, and has fraud jurisdiction over all crypto markets. FinCEN, the Financial Crimes Enforcement Network within the Treasury Department, requires crypto exchanges and money services businesses to register as MSBs and comply with Bank Secrecy Act requirements, including KYC and AML obligations. Every U.S. crypto exchange operating legally must maintain FinCEN registration. The Office of the Comptroller of the Currency has issued guidance permitting national banks to custody crypto assets and participate in blockchain networks, a critical determination that enabled traditional banks to provide crypto custody services to institutional clients. State-level regulation adds another layer. New York's BIT license regime is the most stringent, requiring a specific license for crypto business activity in the state. South Dakota and Wyoming have enacted more permissive crypto-friendly frameworks that have attracted significant custody infrastructure. For institutional investors navigating this landscape, the practical implication is that engaging qualified counsel with multi-regulator crypto expertise is a non-negotiable compliance investment. 3 regulatory risk areas continue to create meaningful compliance exposure for institutional crypto investors despite the progress of 2024 and 2025. First, altcoin securities risk. Bitcoin and Ethereum have achieved effective commodity status through regulatory actions and ETF approvals. The universe of altcoins, thousands of tokens, remains largely unclassified. The SEC's enforcement actions against Coinbase and Binance name specific tokens including Solana, Cardano, and others as unregistered securities. An institutional investor holding any of these named tokens may have reportable compliance issues or face pressure to liquidate. The risk of after-the-fact reclassification is a material consideration in any institutional altcoin allocation. Second, DeFi regulatory vacuum. DeFi protocols, by design, operate without licensed intermediaries, without customer identification requirements, and without traditional broker-dealer registration. Both the CFTC and SEC have stated interest in applying regulatory requirements to DeFi, but the legal mechanisms and specific requirements are untested. Institutions engaging in DeFi strategies face the risk of participating in activity that is subsequently deemed non-compliant. Third, stablecoin legislation uncertainty. Multiple competing legislative proposals would impose significantly different requirements on stablecoin issuers, from light-touch licensing to full bank charter requirements. The final framework, when enacted, will materially affect the economics and availability of the stablecoins that underpin institutional DeFi and crypto trading activity. 3 forward-looking regulatory scenarios inform institutional portfolio planning. Scenario A. Comprehensive legislation enacted. FIT21 or an equivalent market structure bill passes Congress and is signed into law. This would provide the clearest possible framework, explicit classification criteria, expanded CFTC jurisdiction over crypto commodities, a registration pathway for digital asset exchanges operating as regulated markets, and consumer protection frameworks for retail participants. Institutional investors would have the compliance clarity needed to deploy significantly more capital into crypto markets. This scenario would likely be accompanied by a meaningful expansion of institutional AUM in the sector. Scenario B. Incremental progress without comprehensive legislation. The most likely near-term outcome. ETF approvals continue for additional assets. The SEC's new leadership advances rulemaking to clarify securities classification boundaries. Enforcement actions become more targeted and less sweeping. CFTC jurisdiction expands through guidance rather than legislation. Institutional participation grows, but residual classification uncertainty for altcoins and DeFi remains. This is the environment to plan for in 2025 and 2026. Scenario C. Restrictive or adverse framework. Court defeats for the crypto industry on key classification questions, unexpected legislative outcomes, or international regulatory developments that create contagion. For example, a major economy implementing blanket crypto bans would represent a setback. This is a genuine tail risk scenario, low probability in the current environment but not negligible, and institutional scenario planning should include stress test assumptions reflecting it. 5 regulatory due diligence requirements for institutional crypto compliance in the current environment. 1. Restrict the direct crypto portfolio to assets with established commodity treatment, Bitcoin and Ethereum, unless specific legal analysis for your mandate and jurisdiction concludes otherwise. The classification certainty for these 2 assets provides a defensible compliance foundation. 2. Engage legal counsel with genuine multi-regulator expertise. The SEC, CFTC, FinCEN, OCC, and state regulators each impose different requirements on different aspects of crypto market participation. Generalist securities counsel is insufficient for institutional crypto compliance. 3. Maintain active monitoring of legislative and regulatory developments. FIT21 Senate path, SEC rulemaking under new leadership, and CFTC guidance updates can materially affect the compliance landscape on timelines that require proactive rather than reactive management. 4. Document the regulatory classification basis for every crypto asset held in institutional portfolios. This documentation protects against enforcement exposure if asset classifications are subsequently challenged. 5. 4 RIA mandates holding crypto ETFs ensure internal reporting, custody documentation, and client communications reflect these holdings accurately under standard ETF frameworks. The regulatory treatment is clear, but institutional compliance requires explicit documentation that the framework has been applied correctly. Regulatory clarity is the single factor most likely to drive the next wave of institutional crypto adoption, and it is evolving faster than most compliance teams can track. Crypto Mechanics monitors every major regulatory development and translates it into actionable institutional analysis. Subscribe now to stay ahead of the regulatory landscape that will define the next chapter of crypto investing.